Everybody in the joining on there, Clark? You got everybody out of the waiting room?
Yes, we are good to go.
Okay, good afternoon, everyone. Hope everyone had a wonderful long weekend here in Canada. My name's Craig White from the Kelowna office of Plena Wealth Advisors. As you can see, we have Clark White joining as well. Pretty lucky, beautiful sunny day here in the Okanagan for a mid-October day. Appreciate everybody logging in. As we've seen, we've had pretty high demand for this estate planning essentials that Clark's going to walk you through. I think that's a reflection of the demographics of a lot of the clients that we work with, and it continues to be an ongoing conversation that we hear within our practice, not only here in Kelowna, but also within our Vancouver office. And it's something that myself and Clark and Jay and John and the other longer standing team members here, we've worked on building out to provide that to our clients because, as I said, it is in high demand. So we're going to walk you through probably for about 45 minutes. Clark's got some pretty compelling slides here. I'll walk you through some high-level stuff on some financial planning as well as some estate planning considerations. A little bit about our team here. We always like to introduce who we are. As you can see now, we are a team of 13 and a lot of familiar names across this page here. But really, you can kind of see how we've built out Plena, and what we're really trying to do is build the best bench strength for wealth advisory teams here in Canada, and essentially in North America as a big part of our business as well as cross-border solutions. So again, you can see from our wealth advisors to the associates that many are familiar with, and to the financial planning team, which comprises Clark today, Alan, and Tamara, and then many of you are familiar with Sherry and Alex. So again, we're pretty proud of the team that we've built out, and big part of it, as I said, is the financial planning. And really, when you look at financial planning, that's part of the ongoing planning process that we talk about, which I would say this summarizes what wealth management is today, all the way from investment management, tax planning, charitable giving, financial planning, as I mentioned a few moments ago, cross-border solutions. That's a big part of our offering as well. And then as part of that is insurance and estate and trust services, which is the purpose of today's webinar, which we hope is going to be the first of a number of series of seminars that we're going to do throughout 2025 and into 2026 to continue to build out that offering to clients. So a little bit on the agenda. What is estate planning? Some key terms many of you may be familiar with. Some estate planning strategies for consideration. And we'll wrap it up with where kind of everything fits into that estate planning bucket, and the importance of financial planning. We'll leave questions to afterwards. So if you do have anything that we didn't touch on, please reach out to any member of the Plena team here, and we'd be happy to answer that, or via email to anyone on the team as well. So there's an introduction. I'll turn it over to Clark. He can introduce himself and take you through the slides.
Perfect. Thanks, Craig. For those of you who don't recognize me or know me, I'm one of the financial planners on the team that Craig mentioned. And generally, my role here is looking at all aspects of financial planning. So whether that be cash flow management now and in the future, looking at net worth and net worth projections, taxation, and then generally what's left at the end of the day. And that's what brings us into what is estate planning. And so estate planning involves organizing your assets for effective management and distribution during your lifetime and after your passing. The main goal for most of our clients is to maximize the value passed to heirs while minimizing taxes, probate, and other costs in the process. And that last bullet point, I think, is a great one, is estate planning is the creation, preservation, and conservation of wealth at the time of death. So I'm going to review a few key terms. If I refer to these throughout the presentation, this is what I'm talking about. So just wanted to provide a quick definition for a few key terms. The last will and testament, or generally what we refer to in Canada as your will. That's your legal document outlining how your assets and property will be distributed after death. We have your executor. That's the person who's responsible for carrying out the instructions in the will. Your beneficiary or beneficiaries are individuals or organization, potentially charities, who are going to inherit your assets. Then we have probate. So I know that's a big topic in Canada, especially with the probate fees. So probate is the legal process that confirms the appointment of the executor and the validity of your will. So it's confirming that that's your last will and testament. It'll go through the courts here. And in British Columbia, probate fees are 1.4% of your of your assets for any value over $50,000. Uh, Probate fees vary by province to province. In Alberta, they're $525. In Ontario, another example, they're 1.5% of your estate. And the key there is to minimize probate if we can. Lastly, power of attorney. So that's going to ensure your financial, legal, and personal care decisions are managed according to your wishes during an incapacity. As far as estate planning strategies that we're going to review today, a few off the top: beneficiary designations on your registered accounts. We're going to talk about joint ownership of assets, so whether that be real estate or investment accounts, some lifetime gifting, blended families, trust planning. We can look at some charitable giving strategies and taxation around charitable giving strategies, life insurance, and lastly, secondary wills. So first and foremost, with beneficiary designations, so naming a beneficiary on registered accounts, so an RSP account, a tax-free savings account, maybe a RIF account, those allow the assets to bypass probate in the will, and in some cases defer taxes. And I'll come back to why it's in some cases. Otherwise, your RSP or RIF assets are going to be taxed as ordinary income on your final tax return. And if you refer to the chart on the right-hand side, you'll notice in BC here, I've highlighted that last line item. So for any account value, an RSP account value over about $260,000, on the second spouse to pass, your RSP is going to attract about a 53.5% tax rate in BC. If we look at an example, let's say there's a $500,000 RSP account, you're the surviving spouse and happen to pass away. Essentially, half of that account, or $250,000, would be payable on your final tax return. But coming to our next slide here is the spousal designation. So there's some tax deferral strategies that can apply with beneficiary designations, and that's as long as the beneficiary falls into a certain category. One being a spouse or common law partner. Number two, a financially dependent child or grandchild who's under the age of 18. And number three, a financially dependent child or grandchild who has a mental or physical infirmity. So generally, when we're looking at a couple, if the first spouse is to pass away, there's going to be a tax-free rollover on those assets to the surviving spouse. It's on their final passing when that would be taxable as income on your final tax return. And that's where we can start to strategize and maybe wind down certain accounts in a tax-efficient manner. So we help to alleviate that tax bill at the end of the day. Similarly with the tax-free savings account, so those are not taxable to the estate and can directly be paid to a named beneficiary. You may have seen some terminology on your account statements, the successor holder. So that's a spouse or common law partner. And if you're naming a successor holder on your tax-free savings accounts, that's going to allow the new holder of the tax-free savings account to continue with your existing account. So any and all future income is going to remain tax-free, and there's no impact to TFSA contribution room going forward. What we mean by that is, let's say there's a couple, you both have $150,000 in tax-free savings accounts. The one spouse passes away and you're named as the successor holder. Your tax-free savings account value is now going to be $300,000. You're gonna continue to get the tax-free growth on that account, and you're still able to contribute your $7,000 or annual contribution room going forward. So there's a benefit there is having your tax-free savings accounts maximized as much as you can going forward. Because if you do pass away and have some unused room, unfortunately, you lose that when you pass away. Next is the beneficiary designation. So that's going to be anyone else named on the tax-free savings account, a child, friend, niece, nephew, etc. And they're going to receive the value of the account on a tax-free basis. One thing to note, though, is any increase on that tax-free savings account between the date of death and the date it's paid out, if there's a gain in that account, it's taxed as ordinary income to that beneficiary. So if there's an extra $1,000 of increase in value from date of death to the payout date, that's going to be taxable to the beneficiary if it's not your successor holder spouse. And they have the ability to contribute to their own tax-free savings accounts with those proceeds as long as they're within their own TFSA contribution limits. Moving on to contingent beneficiary designation. So you may have heard this term before as well. Generally, a contingent beneficiary is essentially anyone that's second in line to receive the asset. So we're going to have your main primary beneficiary named. They're first in line to receive the asset. And then the contingent beneficiary, maybe you name your adult children on a tax-free savings account as contingent or secondary beneficiaries. And that gets activated only if the primary beneficiary cannot accept the assets. Where it comes into play often is we see maybe there's a couple and something happens in an incapacity manner where now you have your power of attorney acting for you. And powers of attorney don't have the ability to update beneficiary designations. Let's say something happens to that primary beneficiary on the account, but you have your incapacity, so you can no longer update that account designation. That's where the contingent beneficiaries are going to come in, and you're going to have named beneficiaries on the account. So you're going to avoid probate in that process. Your wishes are still carried out in the manner that you want, and there's just some protection and flexibility in there. So that's what we're referring to when we're talking about contingent beneficiary designations.
Clark, on that point, can you comment on the rare occurrence where we've seen from an external TFSA or RSP or RIF where a minor is designated as a beneficiary on the account? What are the implications of that? People should be aware of avoiding that mistake?
Yeah, so generally we don't want to name minors on tax-free savings accounts or in some cases RSPs because essentially the TFSA stays open and they can't release the assets to the minor beneficiary. So we really like to avoid having that minor beneficiary named on a registered account. The better option there is to name that in your will. So you have your primary beneficiary, and then if you have any minors that you do want to list, is having that set up in your will. So maybe there's a trust provision in there. So there's a guardian to look after the kids, and there's a trust to look after the funds for distribution at a later date. Another topic we come across and get a lot of questions on is the joint tenants with rights of survivorship. So the joint accounts essentially. Generally, there's equal ownership, so each joint tenant has an equal share of the property or assets. And the main clause there is rights of survivorship. And that happens when one owner dies, essentially their share passes on to the survivor of the asset. That's going to avoid probate since the assets aren't going through the will or through the probate process. And generally, from an estate planning perspective, having spouses set up with joint accounts or having joint ownership of property, that's going to alleviate the probate process and make that transition a lot easier. A few notes for anyone in Quebec. They have a few different rules and regulations there, so it's not recognized in Quebec. And the second point is having caution when adding adult children on joint accounts. So generally we get asked, should we be adding, maybe something happens to that first spouse and we're looking at adding an adult children onto the home or onto a joint account for the main purpose of avoiding probate. Some caution should be exercised there because a breakdown in their relationship may expose those assets to claims by potentially an ex-spouse. So something to be mindful of. And secondly, potential for additional filing requirements. You may have heard back in 2023, 2024 on the Bear Trust filing that the CRA released. They ended up backpedaling and reversing that. But essentially, what they were looking for is to report the ownership of the asset and um, who's on title of those assets. We might see that come back in 2026 or later. There's been no rumblings of that right now, but the government could change their stance on that. So just be aware of potential filing requirements if you're thinking of adding maybe a non-spouse to a joint account. As far as gifting assets go, so this can be a good estate planning strategy, mainly to reduce your estate value. So if you have some assets in your hands that you want to pass on to maybe some children for a down payment on a home, or just to get out of your hands and avoid probate there, you could consider gifting assets while you're still living. Those aren't going to be subject to any probate fees because they become immediate property of the recipient. A few cautionary tales, though, is loss of control. So once you make that gift, you do lose control and legal ownership and decision making of that asset. So just be mindful when you're making those gifts if it's a large lump sum potentially. And secondly, is the impact on any government benefits. So if you're thinking of distributing some assets in a non-registered account that's maybe in a large capital gain position, there could be some tax consequences that may drive up your tax liability and thus be subject maybe to some old age security clawback or some other clawbacks there. So something to be mindful of when we're making these gifts. As far as gifting strategies with non-registered assets, like I mentioned, gifting a lump sum amount or maybe annually, and being mindful of that capital gain tax when there's unrealized gains in your non-registered accounts. Secondly is RIF or RSP assets. A strategy we come across on an annual basis is maybe making use of excess RIF withdrawals. So you can strategically gift those funds or maybe use them for spending, maybe for some spending or topping up your tax-free savings accounts. That's going to help reduce your estate taxes and start to lower that RSP or RIF account value and save on estate taxes. But beware of the impact on your annual income tax return. So the more money you take out on an annual basis, that's going to start to drive up your tax liability. We can generally review those strategies as we go through the financial planning process. And lastly, with property, as I mentioned earlier, exercising caution when gifting real estate assets. They may become part of the matrimonial assets for adult children and subject to division in the event of a separation or divorce. And another main question we get asked is if you're maybe potentially thinking of gifting property is how do we avoid paying any taxes there? And the short answer is it can't be done, and that's because the CRA is treating gifted property as a deemed disposition, sorry, at fair market value, and that's going to trigger any capital gain tax on appreciation. Generally, that'd be looking at maybe a secondary property and not your principal residence. Moving on to some blended families, potential second marriages, or more complex situations. So just a little bit more thought needs to go into balancing your estate plan here because there's potential legal obligations, balancing fairness and emotional dynamic. So updating your will is the best thing that you can do. So that's going to clearly outline how you want those assets to be distributed among current spouse, children, potential stepchildren. And without the valid will, those intestacy laws may exclude some people that you wanted to give some assets to upon your passing. Another strategy we can look at is the use of trusts to protect assets. So you may have heard of a spousal trust before. What that does is allow your spouse to use your assets during your lifetime with the remainder named to beneficiary, maybe your children at the end of their lifetime. The spousal trust can also be beneficial if you're potentially worried about your surviving spouse remarrying and those assets getting commingled in a second relationship. That spousal trust is going to protect those assets from maybe a future marriage breakdown or claim Secondly, maybe a family trust that's going to help distribute wealth fairly and reduce potential tax burdens or legal challenges going forward. Before entering a relationship, consideration for a marriage or cohabitation agreement, that's going to help clarify kind of rights of property and protect inheritances right off the bat. So both of you maybe have an understanding of what that looks like before you enter into that relationship. Continuing on with blended families, reviewing your beneficiary designation, so ensuring your RSPs, tax-free savings accounts, maybe life insurance policies are updated to reflect current family structure and those intended beneficiaries. If you have to plan for any support obligations like child or spousal support, you want to be mindful of that. And then open communication goes a long way. And I know these conversations are sometimes hard to come by, but having those initial conversations and kind of sharing your intentions can go a long way to protect family harmony. Coming down to trust planning. So trust can be a useful tool in the right circumstances. As far as trusts go, there definitely is some privacy with the trust. So unlike your wills, which are public documents, the trusts are not public documents. They allow you to have control over distributions. So you can specify maybe when and how beneficiaries receive assets. That's very compelling for minors or potentially spendthrift heirs or spendthrift beneficiaries. For example, having a trust set up for minor beneficiaries to control the distributions is something that a lot of parents look to when their kids are younger. So if anything were to happen to them, they can control those distributions maybe at age 25, 30, 35, for example. There's also some tax planning benefits of the trust. You can help manage some capital gains and income splitting abilities. Generally, the income from the trust can be paid out to the beneficiaries. If they're in a lower marginal tax rate, there's some income and tax planning abilities within the trust. And then another big one on trust is protecting vulnerable beneficiaries. So whether that's preserving government benefits for a disabled beneficiary or shielding assets from creditors, there's some protection that the trust has that maybe not having a trust wouldn't come with. And then avoiding probate. Depending on the type of trust that you have, you can bypass probate fees, potentially saving time in the courts and probate fees. And then highlighted in the middle of our screen is just something to be aware of with trusts is the 21-year deemed disposition rule. And what that states is every 21 years, the trust is essentially deemed to have sold all of its capital at current fair market value. That's going to trigger a taxable event within the trust, even if no capital was sold or no property was sold within the trust. That's a CRA rule that's implemented in the legislation. So every 21 years, if this trust is going to continue for a long time, just have some consideration for some capital gain tax that might be payable every 21 years going forward. Second to that is potentially high setup and ongoing maintenance costs of the trust. So there's the setup fees for drafting the trust deed and the lawyer fees, and then there's annual accounting costs for the trust income tax return, which in Canada is referred to the T3 return that would need to be filed annually because the trust is a separate legal entity. Coming down to some charitable giving strategies, you may have discussed this in the past, but the charitable giving strategies allow you to reduce your taxes through donation tax credits. And we can look at some tax planning strategies using in-kind donations. And that's going to help maybe keep your cash flow intact. You can help simplify your estate planning by directing assets directly to charity. And you potentially can preserve more of your estate by offsetting some final taxes. So we'll look at ways to give through charitable giving. Maybe that's a bequest in a will as a fixed amount, a percentage, or the value of your residual estate. You can name charities directly to your RSP, RIF, or TFSA accounts as a direct beneficiary designation. Or there's the charitable remainder trust. So that charitable remainder trust is going to provide income to you during your lifetime, with the remainder going to charity. That's a little bit more complex and has those ongoing maintenance and fees that I just discussed with the everyday trusts. As far as charitable donation tax credits in BC, you're going to get 15% on the first $200 donated, and then between 29 and 33% on amounts over $200, and that's dependent on your income level. As an example, the combined federal and provincial tax credits can reach up to almost 50% in BC. And while you're still alive, if you're making those charitable donations, you can offset 75% of your net income annually. Where it comes as a little bit more of a benefit is in the year of death. So that limit increases to 100% of net income, and you can use some unused credits, and they can carry forward for 5 years. What I think of there is potentially if there's a large RSP account in your and you pass away, having a charity named as a beneficiary, potentially that's going to offset that large 53.5% tax bill that we looked at earlier. So there can be some strategies as far as naming charitable giving strategies within your registered accounts. Generally, with a lot of our clients, they like to name their children and maybe look at donations a different way, which that brings me down to the benefits of in-kind donations. And what that means is essentially donating securities, stocks, mutual funds directly to a registered charity in kind. And what that does is you don't have to pay the capital gain tax on any appreciation in that security when you donate that security. For example, if we're looking at maybe a bank stock that's appreciated $1,000, if you were to donate that security in kind, you're going to avoid paying that capital gain tax on the security. You're still going to receive the full fair market value for your donation, and that's going to help you avoid the capital gain tax, and you're still going to get the charitable donation tax credit. From an estate planning perspective, donating some assets in kind upon death can help offset those taxes that I mentioned, especially from RSP or RIF accounts. And then there's flexible asset types as well. So in-kind donations can include those publicly traded securities, so stocks or mutual funds, potential real estate, art and collectibles, life insurance policies. Generally with real estate and art and collectibles, it's harder to put an appraised value on that. So generally, if you're making some donations, we look at those in-kind donations from a non-registered account. Moving forward on life insurance, this also can be a fairly good estate planning tool because you have the ability to directly name a beneficiary. You're going to avoid probate. There's also a tax-free payout that happens with life insurance. And what that life insurance does is provide immediate liquidity either to a beneficiary or potentially to pay that large estate tax bill. So if you have an insurance policy in place to offset that large RSP that's getting taxed at 53.5%, that's going to help maybe balance some inheritances, provide some liquidity as needed. On the left bottom hand side of your screen there, I've listed the main policy types in Canada of life insurance, that being term life, universal life, and whole life. Generally, term life being the least expensive and whole life being the most expensive. But keep in mind, if you are looking at maybe life insurance as part of your estate plan, you do have to qualify for medical underwriting. So it is based on your health conditions at the time. And if there was some life insurance that you wanted to explore, that's something we could help walk you through. And lastly, as another estate planning strategy is the secondary will. These come into play generally when we're talking about clients that maybe have a private corporation or a holding company set up. So generally your primary will, that's going to cover your assets that require probate. So your real estate, your investment accounts. Your secondary will is covering assets that don't require probate. Like I mentioned, private corporation shares, a partnership. And what that can do is save you 1.4% if you're in BC, or save you the value of probate in the process. If we look at a corporation in British Columbia worth $2 million, that's going to save $28,000 in probate fees having that secondary will in place. And just a note, if you are in BC, we do require a separate executor for personal and secondary wills. And then moving down to a separate will. So for any clients that maybe have real estate out of Canada, maybe that's in the US and Arizona, having a separate will to deal with each country's assets in each country, that's going to ensure the assets dealt with correctly according to the laws. So in US, they have different laws than we do in Canada. So having two wills set up, one to deal with your US domiciled assets, one to deal with your Canadian domiciled assets, that's going to help expedite the process and have your intentions looked after. Like I mentioned, that's going to isolate the probate process to only assets located in that country. I know in the US, depending on where real estate may be held, maybe it's not a separate will, but a trust deed or some type of beneficiary designation that you can make on your real estate instead of the separate will. Coming down, we mentioned the estate planning bucket. So this is more of a visual just to kind of help identify where assets are going to fall upon your passing. So on the left-hand side, if you picture your estate as a bucket and their assets are going to flow into your estate bucket, your registered account bucket, or maybe the secondary will bucket. So any assets like real estate, non-registered investment accounts, bank accounts, a trust that's set up in your will, that's going to flow through to your estate bucket. It's going to go through your will and incur probate fees. In the middle of our screen, the registered account bucket. So that's going to be any RSPs, tax-free savings accounts, or life insurance that has a named beneficiary on that account. That's going to fall outside of the will, not going to require probate. That's kind of your registered account bucket. And then lastly, the secondary will or trust bucket is you can avoid probate fees and the assets are going to get distributed according to that secondary will or the trust deed. Those, again, are going to be shares of your private corporation, potential partnership interests, or maybe a living trust or a spousal trust that are going to fall into that bucket. And then lastly, the importance of financial planning. So just relating back to general financial planning, when we're building out these financial plans, we're going to review current income sources and taxation. So that's taking into account pensions, Canada Pension Plan, RIF payments, maybe some rental income, non-registered investment income. We're going to look at all these various sources. We can review current and future taxation, current and future cash flow planning, and net worth projections as well. We can also look at modeling some scenarios. Maybe you're thinking of gifting some assets to adult children, maybe adding someone as joint ownership on an account, looking at insurance coverage, and the impact on taxes or estate plans down the road. As far as estate planning goes, we also include an estate analysis that's going to include final taxes payable, any applicable probate fees, and your net estate or your legacy. And that just allows us to stay on track through retirement and on top of your estate plan. If you've gone through the financial planning process, you may have seen these graphs on the bottom here. So this left-hand side is a retirement goal coverage graph. That's just showing us that as far as cash flow is concerned, you remain on track to meet your spending goal all the way through to the end of the plan. Secondly, we have your legacy goal. So we can see here in this example, there's roughly $4.8 million that would be left over as a legacy goal. So an after-tax value that could be passed on to beneficiaries. And then on the far right-hand side here, we see a net worth projection over the life of the plan. So we can see over time how various asset classes are changing. This light blue bar along the bottom, generally real estate, our dark blue bar being the RSP or RIF accounts. And we can see in this example that we start to spend these down before the end of the plan. And what we're left with is your tax-free savings account value and the value of your principal residence. And Craig and I often come across if we can be left with a tax-free savings account, which is tax-free upon your passing, your principal residence, which is also tax-free upon your passing. If we can be left with those two assets at the end of the day and maybe some life insurance policies, then from an estate perspective, we're really efficient and from a tax perspective as well, not having a big final tax bill upon your passing. So those are some of the general topics we cover when we're looking at financial planning. And then Craig, I'll pass it on to you to speak with Solus Trust.
Great. Yeah, thanks very much, Clark. Certainly a lot of information covered in kind of 30, 35 minutes here. So, we try to address things on this webinar and in our in-person meetings more at a high level, but Clark will attest to that every client's and household situation is a bit different and a bit unique. A lot of these things you've probably heard any member of our team talk about in the past, but as we move forward and whenever there's any changes to the financial planning process, we always look at the impact and making sure that we have the right beneficiaries labeled and what have you. Go back to kind of my opening comments on why we've started doing these more on a regular basis is really because of the demand that we are seeing across our client base. And I think you're seeing that across the Canadian investment landscape. One thing that Raymond James did recognize as well over the last number of years is that demand. And as few of you may know, hopefully most of you know that Raymond James, we did acquire Solus Trust within the last few years, creating what is now more or less the largest independent trust services offering here in Canada. And really what that does, that allows Raymond James Solus Trust, if they are hired, or if we do decide to work with them, they can fulfill executor or executor support duties. They can serve as an appointment under a power of attorney. They can also act as a trustee to facilitate the ongoing management and distribution of assets, as Clark mentioned, on trust planning. So we are seeing a lot of clients bring on Solus Trust maybe as a backup executor in the event that their primary executor does not want to fulfill the duties of your will. So if you do want more information on that, please do reach out to us. We've got some brochures that we do share. That is also available on our website, planetwealth.ca. But overall, yeah, we thought we'd spend, as we said, 30, 40 minutes today, just keeping you updated on where we are from a estate planning perspective. As always, any questions, comments, please reach out to any member of the Planet team. As you can see, our two offices out of Vancouver and Kelowna here. Thank you very much for attending. Clark, thanks for putting the slide together. And we'll probably look at sharing this as well over the next week or so. So thanks very much, everybody, for tuning in. And as always, any questions, please reach out.
Thanks, Craig.